Start the recording. It started. Yeah. So we should be good to go. Cool. So if you see me pausing and taking breaks through the webinar, it's probably because I'm admitting people. So that normally causes me to lose a little bit of focus as we go along. But anyway, the markets, to be honest, haven't changed. It's been very, very straightforward over sort of the transition from 2024 into 2025 is basically exactly the same. So what we've seen recently is a large dollar dominance. So I'm going to go into some of the technicals on the dollar that you need to be aware of as we're heading into, well, we're actually already in Q1 now, but as we are in Q1 into Q2. So what we've got essentially is the quarterly chart here. So this is the 3 months on the US dollar index. Let me just change this. Hold on. Sorry, guys, 1 second. There we go. So we've got a very clear ascending channel here on the dollar, which I think, we could all say is pretty relevant. It's been holding its ground really since 2009. So it's not something really that we should ignore. But what we've had is a failure really to reach the bottom of this channel again since when was this? 2021. And since then, we've seen some downside movement. In the grand scheme of things, nothing too major. But this was, of course, when we had the deteriorating labor market within the US. We saw a pretty strong cutting, well, a cutting cycle by the Fed. I wouldn't say it was necessarily strong. Um, and now we're seeing a lot of general data for the US. So GDP is fine. Inflation's not a huge concern. It's a little bit over target, but it's not a big, big deal. We've got the Fed saying that the rate cuts are slowing down or they're planning to slow down. So we may get one more, one or two more. I think there's 20 to 50. I think it actually might be 25 basis points currently expected for this year, which isn't much. It's like one small cut by the Fed. So again, that's leading to a lot of dollar dominance and a lot of inflow into the dollar by the bulls. So in terms of technicals, where are we looking for targets? Well, of course, we've got 110, which is actually down here, which is a relatively small target. I think we'll get there pretty soon, maybe even this week if we see NFP come out positive for the US dollar on Friday. Beyond that, we've got 112.2, which would be a retest of the previous three monthly candles. This was in October 2022 and July 2022. So that's kind of where I'm buying into. This is a long-term target, keep in mind. Now, just something else you should also just think about before we get too crazy on buying the dollar. We also need to pay attention to what happened in 2016. Now, the reason 2016 is absolutely key is because if you guys remember, Donald Trump was elected. Now, obviously, we're seeing exactly the same thing now. Donald Trump will be in office this month. I'm not sure the exact date that he actually takes over, but it's going to be quite a
20.
big deal. So we go ahead and have a look. Back in November 2016 is when he got into office. So let me just find that. So it was around the 4th of November, give or take. Now, what did we see? Well, we see basically the same thing that's already happened or currently happening now. We're seeing a lot of dollar buying. So we saw an 8% rise within the dollar from Trump's election up until when's this? Actually, December. So it's actually quite a quick and short rise, but it's still something to pay attention to. Now, this move was followed by a huge 15% decline. I apologize about my camera, by the way. For some reason, it does this sometimes, I think, when it loses focus of me or it can't track me properly. But anyway, it is what it is. So we're followed by a 15% decline on the dollar after an initial Trump rally. Now, again, you could say the same thing. So when Trump was elected this time, it was around, well, it's November again. So it was around the 5th. I think it actually was the 5th. So we're seeing the same thing. Initial rally on the dollar. Now, is it going to be followed by a huge 15% decline? I'd say it's unlikely because obviously it's not just due to Trump. It's obviously it takes into account the macros behind what's driving the dollar in terms of, again, GDP, inflation, the labor market, what the Fed's doing, those types of things. And at the moment, it's all very positive. So I wouldn't suggest that we are going to have a huge, huge sell-off on the dollar, but it's just something, again, seasonality, historical prices, it can generally start to lead price now and again, especially if there's economics are quiet, traders sort of looking for something in the market. So seasonality can come into play then. But again, it's not strong enough, I don't think, really to drive a 15% decline in the current environment that the US economy is in. Now, the counterparty, the euro. So typically, when we see the dollar rise, we see the euro fall because obviously there's buying and selling. People sell off euros, they buy the US dollar. That's just very typical basics of Forex and currencies. However, we're not just seeing a case of dollar bull, euro bear. We're seeing a huge discrepancy between what's actually driving these two currencies. Now, the euro is in the bin. It's in absolutely no situation where you really should be looking to buy it unless it's against an even weaker currency. Now, there are a few outliers, which again, we can go into that later, but on a broad perspective against the other G10 currencies, so the dollar and the pound, you really don't want to be going long on the euro. So, what's really going on with the euro? It's actually pretty simple. It's just a very poor economic climate for the euro, mainly driven by Germany, actually, which is leading to not a great perspective on the ECB. So, the ECB is the European Central Bank. So, let me pull up my data here so you guys can see it. I just need to log in. Apologies again about the cameras. Unfortunately, not much I can do about that. By the way, hello everyone. Sort of got off on a roll here and didn't really say hello. So let me pull up the central bank probabilities. If you're in the Discord, you'll have seen this today when I put it in, but we've also got some free people in here in the Telegram. So European Central Bank, there's a 95% expectation or probability, whatever you want to call it, is fine, of a cut, and this will be in January, so the end of this month. Whereas if we look at the Fed, they're expected to hold again, it's basically the complete opposite. So 95 cut for ECB, 90% hold for the Fed. So that's already, again, it's basics, Forex basics 101. What are central banks doing? Where's the divergence? How can we capitalize? In this situation, we buy the dollar, sell the euro. Bank of England, it's a little bit mixed, but overall the economy isn't in a good place. But again, it's definitely not as bad as Europe. The Bank of Canada, Bank of Australia, Swiss National Bank, Bank of New Zealand, all looking like it's going to cut. The yen is a very difficult topic that again we'll touch on slightly later in this webinar because I'm gonna be honest. It's I, I've got no idea what the hell is going on with the yen, which is actually one of the reasons. Again, if you watch our content or my content regularly, you'll probably have heard me say that I'm basically done with the yen. I don't really have any plans to touch it for the rest of this year, at least. So, moving forward, how are we going to make some money is the big question. So, the watch list is actually pretty scarce. Now, again, even if you're in the free Telegram, you will know I have been saying euro dollar short since August to September. And since that time, it's just been falling off a cliff. This is probably the most obvious and most clear trade I've ever seen, really, to be honest, because it was one that was very easy to project. So looking into the market, it's been very difficult to actually get any solid swing trades from my perspective anyway. Obviously, it depends on the way you trade and what strategy you follow. But for the way I swing trade it, it's been next to impossible because basically, for you, again, anyone that doesn't know, I look for fib pullbacks. I look for some structure within this fib level. So, for example, this was a great potential entry because we had a fib level through here, previous low acting as support through this level. So it would have made sense for this high to come up a little bit higher, retest, and then we go short on this fib. However, it's just not done that. And this is one of the problems with trading such extreme markets like euro dollar when we have a large discrepancy in the market drivers. Because oftentimes we will just see so many sellers in this market, pullbacks are next to impossible. And you can see it has been that sort of situation. We've seen very small moves to the upside, but again, it's more small corrective behavior, nothing substantial that we could really take a serious entry from. So going forwards, we're still looking for parity. It's still my sort of number one priority is seeing euro dollar get down to the 1.0 level. If you don't know what parity is, essentially it is just 1.0 on the euro dollar chart. But what that means is the 1 euro is the equivalent to one US dollar. So it means the exchange rate is 1 to 1. Um, this isn't really a good sign for euro dollar, or specifically, sorry, for the euro. It means the euro is very weak if that level is hit, which again is a little bit of a concern, which is why it's such a priority for me to see that level get hit. Because, by the way, I have a tendency to start yapping and talking quite fast. If you want me to cover anything, you want me to repeat something, feel free to ask.
Mm?
Do that. Obviously, it's what I do for all of us, but mainly you guys to learn something and get some value for the trading week and the trading runs ahead. But anyway, as we see parity get hit, unless we see some major changes within the Eurozone data, it's not looking good. It wouldn't be a huge shock to me. Actually, that's the wrong type of line. It wouldn't be a huge shock to me if we actually come back down to test these 2022 lows. So somewhere in between the 0.97 to 0.95. Oh, people got mics on. I can't hear anything. Hold on, let me just mute people. There we go. You can always unmute yourself if you want to. If you have a question, you can always talk. But yeah. So yeah, euro dollar continue the shorts. If you again, I keep saying this actually, but if you're in the Discord, you will also get the alerts for when I go short. Hold on, let me just pull it up here. So you'll get these alerts for when I go short on euro dollar for DCA positions, which again I've been showing off in the Telegram quite a lot. So that's a nice feature. So we don't really miss any moves on euro dollar. It's more a case of we just average into any pullbacks. So Euro definitely not in a great place in terms of the macros. So if we look a very basic overview, I also sent this out for the Telegram last week as well. So the macro divergence persists between a hawkish Fed and the ECB's cautious approach to to further cuts. Eurozone political risks and underwhelming growth metrics are downside risks for the euro. So again, it's really a no-brainer trade. I think my computer's frozen there. Uh, okay. So euro dollar short, we're looking at Australian US dollar short again, prioritizing this US dollar strength. Euro dollar CAD long, euro dollar short, dollar yen, um, long, pound dollar shorts, New Zealand dollar shorts, oil long, which yeah, I think oil longs make sense, but it's not really a huge thing on my watch list at the moment. S&P 500 long, Euro Swiss short, Australian dollar New Zealand short, and US dollar Swiss long. Okay, so it's very straightforward. Again, I've just said it. It's all revolving around the dollar. Um, okay, cool. So let's just pull up something else here. So Euro Swiss short. So let's cover this one as well, just so we can get a little bit off the dollar dominance. We'll start diversifying our watch list a little bit. So ongoing European political risks coupled with the Swiss safe haven status favor lower Euro Swiss. The ECB's dovish cuts also limit Euro support relative to the SNB's cautious stance. So again, this one is basically driven by the euro weakness that we're seeing. So if we have a look at what's really going on the technicals, we've got the 200 daily moving average here, which is above price, indicating that we should be selling really as the daily trend is to the downside. We've got a relatively nice upwards channel here on the H4 that could be quite a nice area to look to go short. Obviously, we'd need to really wait for um, some sort of confirmation through here. Obviously, we don't really want to sell an uptrend, but the larger trend is to the downside. So if we look to short at this level, this would be possibly the initial entry, and then if we end up coming higher, we'll be stopped out, and then we can look to maybe go short at the next level of resistance where our first stop loss would be. Take profits, nothing overly crazy here. We'd just be going down to this previous low or this sort of wick down here at the 0.92 level. Um, so again, pretty basic stuff really. Nothing too interesting. So yeah, as I said, it's all very straightforward. Again, it's the same as last year or same as Q4 last year. Go over GU. It's starting to look good for shorts on the H1. Okay, let's have a look at GU. Um, yeah, so this is the problem that I'm finding with a lot of these dollar pairs is that these higher time frame setups are a lot more attractive, obviously, because it means we've got a larger pullback, giving us more potential to go to the downside because we are quite deviated or quite far away now from this 200 H4 moving average. We are almost 2% below. Whereas on the H1, you're right, it does look very strong. So it depends on your risk appetite, really. Are you willing to sell this short-term move and potentially get stopped out on a higher time frame move to the upside or higher time frame pullback? To be honest, the way that the dollar crosses have been moving, I would say go for it because I've been waiting for pullbacks on the H4 and the daily on New Zealand dollar, Australian dollar, pound dollar, and I've just missed every single one of them for swing trades. So I would go for this, maybe use half of your percent risk or half of whatever you would normally use. And then obviously you can scale in down the line, or of course wait for the higher time frame pullback. Risk it for the biscuit, exactly. Yeah, I think there's not much else you can do in this situation because, again, if we look at the sort of mean reversion aspect of things, we're very extended on a lot of pairs. Actually, if we look at euro dollar, very extended to the downside. Euro pound, very extended. Actually, we did have a little bit of consolidation here, bringing price back up. The US dollar CAD, again, very extended to the upside. And the dollar knock as well is pretty overextended. Chance on H1 if it doesn't work, can always enter at a higher price. Yeah, that's exactly what I would say is the best idea. In terms of target levels, we're looking really at multiple levels here. So you can see the three orange lines here are where I'd be targeting. So first low down here around 1.23. Then we've got the next low at 1.22. And then the final longer term take profit, in my view, is at 1.211. So again, very straightforward, just using technical key levels really to get in and out of these trends. The Australian New Zealand also doesn't look necessarily too bad at current price. The problem is it is in an uptrend technically here on the H4. If we have a look at the reason we've got slower recovery in China, disproportionately impacts the Australian dollar relative to the New Zealand dollar, which is supported by domestic housing resilience. The relative dovishness of the RBA versus the RBNZ adds to this dynamic. So I wouldn't say it's the strongest trade. However, it's definitely got potential. Uh, just trying to think really how to approach this one properly. Just give me a second. Let me have a think here. Yeah, I think what I've got drawn up is probably the easiest way to do this, really. Obviously, we are selling into an uptrend, but the markets are never perfect. So, just trying to think if there's anything else major. The yen, said we'd cover the yen. The yen's an interesting one. So let me again pull up the research for reference here. Sorry, guys, I'm just gonna take a drink. Give me a sec. Okay, there we go. So the yen with the market drivers, dollar yen driven by rate differentials as the Fed's hawkish stance diverges from the Bank of Japan's cautious easing. Trade dynamics and geopolitical risks keep JPY volatile. Um, yeah, there's no, in my opinion, there's just nothing clear with the yen. So I wouldn't be looking to go long. I think the easiest easiest approach really is to go short into this level. And then what we're looking at on dollar yen is 160. So 160 is really the danger zone. It's where a lot of bank reports are projecting the next intervention by the MOF. Yen more neutral? Yeah, exactly. It's yeah, not my favorite to be honest. But yeah, to be honest, guys, that's about it. Phantom metals, there's nothing to be honest. Sorry, guys, I'm just feeling a little bit unwell, actually. I don't know what's just come over me. The yeah, the metals market, there's no drivers at all. There's yeah, I mean I've covered it in previous videos. The gold primarily was driven by a lot of global uncertainty around sorry, excuse me, around rate cuts and what was it called? Around the global tensions with the Middle East and Russia, Ukraine. A lot of those problems are sort of gone. Global tensions are priced in. Rate cuts by the Fed primarily are over or almost over. So that's about it. Guys, I'm gonna cut this short. I don't know why. I'm sorry. I'm just something's come over me. I'm feeling a bit unwell now. Um, but this will be uploaded. But we've covered most of the main things. But yeah, I'm gonna head off. I'm sorry. Yeah, I'm gonna have to go. Apologies.